Hi everyone, this is the first in a series of videos for Chapter 4, where we will be completing the Chapter 4 workbook exercise problems. In this specific video, we're going to begin the completion of the workbook exercises with the first problem here, AP3B. So for AP3B, we have a listing of different accounts and we need to determine if the normal balance is a debit or credit, and we also need to indicate if a debit or credit will decrease the account balance. And so one thing I think we need to discuss here is the concept of the normal, quote unquote, normal balance. When we use that term normal balance, that just means which side of the T account, essentially, the debit or the credit, remember the left or the right, which side of the account should normally have a balance. And the normal balance is also the same as the side that increases the account. So if cash is increased with a debit, then the normal balance for cash will be a debit as well. Alternatively, the normal balance for revenues would be a credit. Typically, there's not an opening balance, and usually normal balance is associated with the opening or ending balance. For example, with accounts payable, it's a liability. Liabilities increase with a credit, and they also have a normal balance on the credit side. And with that said, if you had a balance that was not on the credit side after accounting for all the activity during a month, or at any given point, really, if you ended up with a balance, an ending balance on the debit side, for example, for a liability, that would not be the normal balance and really would indicate that there's a kind of a negative balance in that account. It's something essentially is wrong there. So for example, if you had a balance in cash of a credit, an ending credit balance, that would indicate that there's negative cash. So maybe the cash account was overdrawn and you actually owe money back to the bank or something to that effect. So, but just keep in mind the normal balance is the same as the side that the accounts increase on. And then obviously the decrease is the other side. So something to remember here is our dead circle acronym that we talked about. And I'll just type it in here real quick. Remember DEAD, and this means debit, expense, asset, and draws. And then we have the CRCL, that's the circle, and that stands for credit. So we know the first letter in both words here is these things all increase with the debit, expenses, assets, and draws. And then these things, revenues, contributions, and liabilities, these all increase with a credit, and also to say they have a normal credit balance. And these accounts have a normal debit balance. Okay, so with that little acronym there, let's go ahead and look. So we've got cash as our first account. We know that cash is an asset, and so we can see that it is under the D. And so our increase side and our normal balance side is going to be the D, or the debit. And then alternatively, if there's only two answers, it's only increase or decrease. And so that's easy for us to understand that the answer will be a credit for the other side. So essentially, once we know what the increase side is, we automatically know what the decrease side is, just because it's the other side. If it's a credit here, it's a debit. If it's a debit here, it's a credit. So really quite simple. Okay, so accounts receivable is an asset, so same situation. And I want to show you one little Excel trick here. Because this answer is going to be exactly the same as the cash, let's go ahead and hold your left mouse button and highlight over these two cells here. And now let's go up and copy those. So we've now copied those two cells, and then we're going to go in and paste this in here because we know that that has the exact same impact, as far as increases, decreases, because they are both assets. And while we're at it, let's go ahead and copy this again. So we'll highlight those and hit copy. And let's look through for any other assets here because they're going to have the same answer. And so remember, accounts payable, that's a liability. Notes payable is a liability. Owner's capital. You can also think of contributions here as with capital, the same thing. And so that's going to be equity and a credit increase. Revenues. And really, we could look for any of these accounts that increase with a debit. So let's look for expenses, assets, and draws here. Okay, so the revenue, it's not any of those. Insurance revenue, same thing, revenue. But prepaid insurance is another asset, so we'll paste that in. And as we paste it in, you can see it remains highlighted. So then we can just click copy again, and we can keep going down the list and do that again. But equipment, yep, that's great. Unearned revenue is a liability, remember? But here we've got withdrawals, and remember, withdrawals, same term there. So we're going to paste that in there. Salaries expense, remember, expense is under the D, so it's going to increase with a debit as well. And finally, office supplies is an asset, and it's also going to increase with that format there. Okay. Now let's look at the next one here. So accounts payable is a liability. It's under the C, so that means it increases with a credit. And by definition, then it decreases with a debit. And then let's go ahead and copy the credit debit combination and just go through. So notes payable is again another liability, so it increases with a credit. And hit copy again. As we said, capital and also contributions, you can think of that as the same thing there. And so it's under the C, so it increases with the credit. Service revenue is the R under the circle. It increases with the credit as well. And it doesn't matter what type of revenue it is, it's going to be the same, whether it's service revenue or insurance revenue, etc. And finally, unearned revenue is a liability. Remember, that's the liability that is created when you receive money from a customer and you haven't yet earned it. You haven't provided the services. It's a prepayment by your customer, but you have the cash. And so it creates this liability called unearned revenue. And just like with all the other liabilities we saw, it increases with a credit as well. Okay. So hopefully that was helpful. You can kind of see how sometimes using copy and pasting, it just makes it easier than going back through and manually typing that in every single time, I think. So definitely copying and pasting things and highlighting cells and making that all work is a pretty important skill in Excel to have, and makes your work a lot simpler. All right, and hopefully that helped you learn how to use the dead circle acronym or the mnemonic device a little bit better, and you were able to go through and see how we just need to know what type of accounts we're talking about, and then we can use this little tool here to understand whether it's a debit or credit that will increase or decrease that account. All right, thanks everybody. And I will see you in the next video where we will talk about AP4B.